Welcome traders, David DeVay of Polaris Trading Group in affiliation with Infinity Futures. We want to welcome you to this edition of the weekly review and preview. Today is Sunday, May 14th, Mother's Day, so we'd like to wish all the mothers out there a very happy Mother's Day. This will be the review and preview for May 15th through the 19th, the upcoming week. Before we get to the preview, industry disclaimers require that I highlight NFA Compliance Rule 2-29, which simply states that hypothetical performance results have many inherent limitations. Trading in futures and derivatives on futures is speculative in nature and involves substantial risk of loss. Past performance is not indicative of future results. Okay, so with that, let's just go to our big picture chart here. And here's a large view of the monthly profiles, or actually daily profiles spanning months, and we can take a look at where we currently are. So for those of you that have been tuning in over the past few weeks now, since we've begun the previews, the market now has cleared the wave 4 high over at the 2376 level and has over the past 2 weeks moved up to test the 2400 level. Now we've been talking about that now for a couple weeks, that's what our expectation has been, and it did test that this past week. So with that test, okay, up here where it says possible wave 1, that was the I think Monday high. They tested it early, there was a rejection, and they pushed it back down. Now what I want to just highlight here, a couple different things. One, the wave 4 high now becoming new support point at the 2376, all right, and as well the new yell. All right, now for those of you that aren't familiar with the yell, what that simply represents is on the day of the Fed, when the Federal Reserve releases their policy statement at 2 o'clock Eastern Time, that is the first tick or trade after at 2 o'clock. So 2381 represents what we call the new yell. That becomes a benchmark or a marker for the market participants. Okay, and as you can see here, over the past 2 weeks or so, the market has cleared that and then has in several days retested that level for surety and support. So far that has been a successful test, so we use that as a one of our key markers that we go forth with the market. All right, so as we zoom down a little bit into this past week, what I want to again, they tested the 2400. Now we're going to go over the option strikes in the latter part of the segment of the video. The 2400 is an important strike price for the market, but as you can see here, we've had lower highs throughout the week, so the market has not been able to accelerate aside from that first push into the 2400. Now that said, it has not broken down either. So having cleared this wave 4 downtrend line that we have over here, the market now is established in a new uptrend, as you can see here. Higher lows, higher lows, higher lows. So that's where, and of course higher highs. So now we're in the process of working on a new move up, but it has been somewhat struggling here at these levels, and we'll take in just a moment we'll take a closer look at some of the sectors that have been driving the S&P's action. Okay, on the next slide, this is what's called the relative rotation graph, and this is a updated weekly. And what it does for us is it takes a look at how the sectors or major markets have been rotating over time. So this is a pretty good visual. This is from stockcharts.com. So if anybody's interested, please visit that site and take a closer look at what the relative rotation graph. But for our purposes here today, what I just want to display is that the NQ, or the NASDAQ area, has been up in the top right quadrant, has been in the leading group, and it has been for quite some time. So as we know, those of you that trade the NQ, all right, that's been the leader of the group. In terms of other parts of the market, all right, the small caps and the Russell, the small to mid cap Russell, right, have been in the lagging group, though they have shown some relative strength as of late. And the reason for that, you can see on the graph here, is that it's actually starting to slope back up. Still lagging on a relative basis, but on an absolute basis, right, day over day, the market has now been exhibiting some new strength in that. So that's good for the market. That's what we call risk-on type of action. So the market is more acceptable to greater levels of risk. So having seen the small caps and the mid caps start rising here is a good sign. Transportation has been a lagger in the overall group, and lastly, the utilities, all right, has been, which is affected by interest rates, by the way, and that has been in a leading position. So overall, at this point, we have somewhat of a mixed condition at this stage. But overall, the market is still, in healthy condition right now, because price has not broken any major levels. All right, so let's take a look at the individual sectors down here, and again, should be no surprise looking at the table down below. All right, technology has been in the leading group. Okay, healthcare, of course, with the healthcare bill in Washington and everything working its way through. That has had a bid. Consumer discretionaries have held up fairly well, although a closer look in that area shows that the brick and mortar retail stores, Kohl's, Macy's, all those type of brick and mortar type retail stores have been lagging dramatically. On the flip side, the online retailers, Amazon and the such, have been simply on fire. So that has helped keep a bid in the consumer discretionary sector. And then lastly, the energy, of course, again, should be no surprise, all right, has been the lagging area. Now, financials have shown some relative weakness as of late. You can see the RGG chart. Now it's XLF, the financial ETF, has now entered into the lagging group. Now again, the reason for that is interest rates have recently, this past week, gone down, so bonds have rallied somewhat. So again, softness in interest rates has a negative effect on financials. As interest rates increase, you'll see financials outperform. All right, so that is the relative rotation graph. Just a quick closer view this past week on an absolute basis. Okay, we did see a little bit of a bounce in the energy sector, but not that strong. Technology, again, leading group. Materials, again, that includes copper, gold, silver, some of the base metals. All right, that's been lagging. And let's see, for the most part, financials, again, we just mentioned, has been lagging as well. So we'll see how this coming week. Let's take a look at what's on tap for this week. All right, taking a look at the economic calendar presented by EconoDay. The calendar is relatively light this week. We have, again, the only major events here that I can see, of course, housing on Tuesday. Of course, the EIA Petroleum Status Report every Wednesday, and then jobless claims there on Thursday. So for the most part, everything else is, flagged neutral. All right, so we don't have a very, very strong calendar this week. So the market's going to be focused, I think, on just the expiring options. So let's take a look at the expiring options area. All right, so this is my board for monitoring the monthly options. Now, again, there are weekly, there are daily options now. I mean, there's a whole plethora of options. I just still focus on the core basic monthly strikes and for interest. And what I want to do here is, what I look for primarily is where the largest open interest is on the call side and on the put side. And that kind of helps give us, as we're intraday traders or swing traders, an idea of where commitment is. And that's the whole idea of looking at the options. Whether you trade options or not, you should be paying attention to options and especially in the open interest part of it, so you can understand where traders, investors have made their commitments. Okay. One thing you'll note that on balance, all right, the call put ratio up here in the top typically leans to the bearish side. Okay, simply what that means is because the market, mutual funds and money managers are primarily long only, they typically hedge their positions. So if they're long, again, just like buying, a car insurance or house insurance, you're buying a put to protect yourself for the downside, adverse, market event. So there's typically a lean to the bearish side, all right, from a hedging perspective. That said, we do want to look at where the calls open interest are, because a lot of times the calls tell us how what the market is sensing on where they think the market may end up going. All right, and again, the calls tend to be more speculative in nature as well, so it can give us a pretty good handle of where commitment is. So as we take a look here, now this is the SPY. You can give the equivalent if you're trading futures, so the 240 strike would be the 2400 futures. All right, simple enough. So as you can see here, this coming Friday, which is expiration, we have 5 days left to expiration. The call side open interest is 340,700 calls open, and we have about 197,000 calls, on the put side open. All right, so that is the largest call put strike price. So what simply that means, there's a lot of hedging that has gone on against that level, and obviously there's a lot of speculation that prices will close above that level. Okay, the next big one on the call side is the 241s or the 2410s, and then above that 242s, or again the 4220s, and then we go out to slightly above the 2430s, which it kind of drops off there. So the 2400s, 10s and 20s has the largest concentration of call open interest, and the largest concentration right now of put interest are the 2400 calls as well. All right. Now on the put side, the largest is down at the 2350s. Okay, looks like that those are currently out of the money, okay, at this stage. So what we're really closest to is the 2400. So we saw this past week a test of that level, and my expectation is we'll probably try to see another test of that level again this coming week. All right, so there's the options, and again, as I said, something that you should be following if you're a day trader or a swing trader, if you're participating at all, whether or not you trade options or not. I think it's worthwhile to keep a close look at the open interest. Okay, and lastly, we're going to take a look at the profile. This is an active chart that we use with our members daily for our daily trade strategy. And again, it highlights some important levels. So just as a quick review, this area here between the 2392s and 2378s, this has been the past 2 weeks, not this past week, but the prior 2 weeks value zone. Okay, and so we've been using that as a marker for the range highs and lows. And as you can see, this past week, again, the aggregate activity of this past week, prices have tested down to the 2378s, found support. Again, something that we were anticipating that the market would do and hold. It also had a high concentration near the lower end of the collective ranges, again around the midpoint of the past 2 weeks value area. So that 2386-85 area has been an important level, again, as we've discussed with our members throughout the course of the week. And then lastly, again, we did discuss early on that we're expecting at least a potential test of the 2400s this past week. We did get that early in the week, and then as you can see, we got a bit of a rejection, and prices traded pretty much within a very narrow range. Now, again, many of you know this, the volume and the activity and the volatility have been extremely light, continues to be so, but hopefully we'll get some expansion of that. A lot of that has to do with prices trading within the context of some relatively narrow boundaries. So for the upcoming week, the new value low now becomes approximately 87.50 here. As you can see, this is the new value area, low area. The new midpoint becomes approximately the 92s, all right, which was the prior, again, 2 weeks value area high level that becomes the mid, and then the high level becomes around the 97s or so, 96, 97. So what does that mean for us going forward? Key levels that we think about now become 92 as potential hold for support. All right, we would look to try to look for the market to hold any tests of any 92s, try to punch up through the 96s, and then move on to test that 2400 strike by the end of the week. Should that fail to occur, okay, again, these are, I don't make predictions, just trying to prepare. If the market does trade back down and converts the 2392s to new, what we call lower resistance, then the expectation would be to come down and test again, 86, 87, 85 zone, okay, and then possibly a push lower if the market is that aggressive. Okay, so again, we try to prepare our members, all right, and our subscribers for what the upcoming events will be, and know what key levels. All right, we do this on a daily basis as well through our daily trade strategy. This is more of an overview, and the daily trade strategy focuses in and hones in on specific levels on a day-to-day basis. Okay. All right, so that concludes our review and preview for the upcoming week. And for those of you that have not visited with us as of late, we'd like to offer you an opportunity to come down, visit us in our trading room, see what we do on a daily basis. You'll get a trial subscription also to the daily trade strategy, where you'll be able to see what we do and how we hone in on our action daily. So visit us at PolarisTradingGroup.com/free-trial for signing up for a free trial. Or you can reach out to me at david@PolarisTradingGroup.com. Visit us at the website, and certainly visit and contact your Infinity Futures representative, or Patrick Zilbauer at infinityfutures.com. All right. Thank you very much for your attendance. Hope this has been helpful and in preparation for next week. And we'll see everybody in our trading room, and good trading to all. Thanks very much. And again, happy Mother's Day to all the fantastic moms out there. Thanks very much. We'll see you next week.